Welcome back, my friends. Institutional investors are pulling back from the U.S. housing market. One big, notable example is Starwood's decision to shop 2,000 single-family rentals. The financial return on each additional home added just isn't that great right now. Today, we hear the news that Starwood Real Estate Income Trust just decided to sell off 2,000 residential houses. Starwood Real Estate Trust, Starwood REIT, is a real estate investment trust, REIT, that primarily invests in high-quality, income-producing commercial real estate properties in the United States and Europe. Starwood REIT was formed in 2009 and is managed by Starwood Property Trust, Inc., a leading diversified finance company with a focus on the real estate industry. Starwood REIT's investment strategy is to target properties with stable cash flows, long-term leases, and strong tenant credit profiles. The company's portfolio includes a diverse mix of property types, such as office buildings, hotels, retail centers, and multifamily properties. Starwood REIT also invests in first mortgages, mezzanine loans, and other debt investments secured by commercial real estate. As a REIT, Starwood REIT is required to distribute at least 90% of its taxable income to shareholders in the form of dividends, which can make it an attractive investment option for income-oriented investors. The company's shares trade on the New York Stock Exchange under the ticker symbol STWD. What does it mean for real estate investment trusts? What does this mean for the real estate industry? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. And, before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the healthcare professional knows the patient identity. Starwood as a real estate investment funds is what is known as a REIT. What is a REIT? For those of you not familiar, a REIT is an investment fund that invests in real estate. REIT is an acronym for Real Estate Investment Trust. It could be structured as a mutual fund, almost like a stock mutual fund. Or, it could be set up as an exchange-traded fund, or ETF. If it is an ETF, then shares in the fund are traded whenever the stock market is open. That means that any investor could sell out whenever the stock market is open. Starwood Capital CEO Barry Sternlicht doesn't hold back on his Federal Reserve criticism. On multiple occasions he's told CNBC anchors that the central bank's aggressive interest rate hikes could soon spur a deep recession. It's easy to see why Sternlicht is so openly critical of the Fed. Starwood primarily invests in real estate, where the Fed's interest rate hikes have already caused a great deal of economic pain. Last week, it was reported that Starwood Real Estate Income Trust plans to shop more than 2,000 single-family rentals. Starwood hasn't publicly explained its motive for pulling back from the residential housing market, where its REIT owns over 3,200 single-family homes. That said, it's clear that the decision to shop these 2,000 homes comes as Starwood faces an uptick in redemption requests and endures pain in the commercial real estate sector. At first glance, one might assume Wall Street types would pull back from the commercial real estate space, where office values are sinking fast, and instead pile into the residential housing market, where national home values are rising again after passing through a mild home price correction last fall. However, institutional firms are also timid on the residential front. According to an analysis conducted by John Burns Research and Consulting, institutional investors, those owning over 1,000 homes, bought 90% fewer homes in January and February than they did in the first 2 months of 2022. Why are institutional investors pulling back so fast from the U.S. housing market? It boils down to the fact that the financial return on each additional home added just isn't that great right now after factoring in interest rates, house prices, and rents. Not to mention, Some big investors like YieldStreet think that national house prices, despite jumping a bit this spring, are poised for another step down. We're pretty much on pause across all home buying strategies. Tejas Joshi, director of single-family residential at YieldStreet, which owns over 700 single-family homes, recently told reporters. I don't think house prices have bottomed yet. On average, we have another 5% decline nationally, and it'll vary by market. Peak to trough, we're expecting 12% to 15% national decline. Not only are institutional investors buying fewer homes, some are reducing their overall single-family portfolios. Look no further than Invitation Homes, the largest owner of U.S. single-family rental homes, which recently became a net seller. In the first quarter of 2023, Invitation Homes bought 194 homes while it sold off 297. A year earlier, in the first quarter of 2022, Invitation Homes, which Blackstone helped to grow before divesting in 2019, bought 822 single-family homes and sold off only 147. Invitation Homes isn't alone. American Homes 4 Rent was also a net seller in the first quarter. In the first quarter of 2023, American Homes 4 Rent sold off more single-family homes, 666, than it bought, 312. That net decline saw the Las Vegas-based company's portfolio shrink from 58,993 rental homes across the country to 58,639 homes. A year earlier, in the first quarter of 2022, American Homes 4 Rent bought 1,131 homes and only sold off 171 homes. If you recall, Starwood REIT had a big management shake-up earlier this year. Starwood Real Estate Income Trust, the second largest non-traded REIT in the country, has swapped CEOs amid a turbulent time for the real estate market and an upswing in investors looking to pull their funds. John McCarthy, who served as Starwood REIT's CEO since its launch in 2017, was replaced by Sean Harris, who had been its president since 2021, according to a Securities and Exchange Commission filing first reported by CoStar. Starwood Real Estate Trust is limiting investor redemptions after the repurchase requests exceeded a 2% limit, reaching 3.2% of net asset value, NAV, in November 2022. The company fulfilled 63% of investor redemption requests in November. The company has a quarterly limit on redemptions of 5% NAV. The ability to redeem shares on a monthly basis is one reason investors are attracted to so-called NAV REITs such as those managed by Blackstone and Starwood. The weakening commercial property market is another reason why private REITs including Starwood's and Blackstone Real Estate Income Trust are contending with high numbers of requests to redeem their shares. Big institutional real estate investors are starting to get some heat from the U.S. Securities and Exchange Commission, SEC. Both Blackstone and Starwood have now limited investors' withdrawals from their funds. In fact, investors are pulling their money out of these big real estate funds at a fast pace. The SEC is now asking for details about these decisions. If you have been following this channel, you already know that the U.S. housing market is in sharp decline. As you might expect in a time of popping asset bubbles, house flippers are getting burned. Fed Chairman Jerome Powell has finally admitted what all of us have known for a long time. Specifically, U.S. home prices are in the midst of a major correction or even a collapse. Institutional home buyers bought houses over the past few years as if they were going out of style. That included iBuyers like Zillow, Redfin, Opendoor, and OfferPad. It also included small-time investors and home flippers. But now, the tide has turned, mostly due to quickly rising interest rates. General sentiment about house prices has been thrown into reverse. And all of these buyers who rushed in are now exiting just as fast. The U.S. housing market is seeming like a speculative bubble once again. And house prices in the United States are in decline. And there are probably a number of investors in the right that think real estate prices will further deteriorate. So, what does this mean for Blackstone? Investors in the fund are furious. That is because many of them are now trying to get their money out of the REIT. Real estate values have fallen across the nation. And macroeconomic factors are weakening overall. So, many investors have current needs for cash and need to liquefy some of their assets. Blackstone and Starwood Capital Group are drawing attention from the Securities and Exchange Commission. The focus is their recent moves to limit the ability of individual investors to take their money out of the company's real estate investment trusts, according to reports that are surfacing. The real estate funds have recently seen a surge in withdrawal requests. amid a broad drop in investor sentiment and potential economic downturn. This led both private equity giants to pause redemptions after monthly and quarterly withdrawal limits were reached. The agency was looking into how the firms served redemptions to their clients. Blackstone launched the Blackstone Real Estate Income Trust in 2017. The fund is designed to cater to rich individuals. Assets flowed into the fund and it was a success, at least for a few years. The real estate market in the United States has reversed course, and investor sentiment is turning bearish, to say the least. Shares in Blackstone shares are down more than 30% from their peak. That compares to a 3% decline in the benchmark S&P 500 index. Unlike stocks, investors in the fund cannot just sell their shares anytime the stock market is open. Instead, they need to contact Blackstone and request a redemption of all or a portion of their shares. If you follow this channel, you already know that the Federal Reserve is aggressively raising interest rates. And the rising interest rate environment is sending real estate values into decline. The real estate market has been hit hard, especially commercial real estate. If you follow this channel, you already know that real estate prices are falling across the United States. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.